All right, thank you. So welcome everybody to our Charlotte Investors Business Daily Meetup group. Roy and I are happy to see you. Some hopefully some new faces, but a lot of regulars as well. So it's a great time to stay up to date with the market. We always encourage people to stay engaged, of course, even when the market is not behaving nicely. And so, clearly the title of this presentation, Market in Correction, just because that's what we're seeing, right? We're seeing a major pullback in these indexes. Um, and we'll talk about just the overall environment and kind of give some context about the market and the economy and try to keep everyone as informed as possible. But the main thing here is that it's a hostile environment. So, tread lightly. Um, there's no need to trade heavy right now. Uh, but we just always want to stay prepared. And I'm sure at the end of this, we'll talk about some of our top picks. And I think when you have a bunch of broken charts, that's when you maybe want to lean on the fundamentals a little bit more of those stocks, where you can be ready and prepared to have conviction and take a stab at some of these stocks at lower prices. But for now, anyways, the market's in correction, and we're actually 100% in cash, and are just debating and trying to figure out the time to try to take any setup. Um, but as I mentioned, this is the Charlotte Investors Business Daily Meetup group. We have somewhere around, let's say, 2,600 members right now, and the the group is kind of grounded in this How to Make Money in Stocks book by William O'Neill, and he has his Investors Business Daily ecosystem of support that he has created over the years. He's not with us anymore, but um, we are a group that has all read this book typically and has learned a lot from it, and we use that to guide our approach to the markets. And so one of the concepts here, the key concept he talks about in fundamentals, is the CAN SLIM acronym. And so we'll talk a lot about those different elements of the stocks that we look at. And just for our disclaimers, we're not giving any financial advice here. So it's for education, it's for entertainment, and please discuss investments that you're doing with your investment advisor. Okay, and so this acronym is something I mentioned from How to Make Money in Stocks. And if you're not familiar, this is something you can find in the book, and it goes through each of these letters in detail, talking about earnings growth and new companies that are making new highs or changing the world. Supply and demand, so looking for those volume cues that might show up because institutions are piling into a stock that's where something important is happening. Buy the best of the stocks. The best stock in the best group is really what you want to look for as far as the leader or laggard. Institutional sponsorship too. You want to know what big money is moving into, and then market direction, which we'll talk a good amount about today because to us we see the market changing trend, and it's in a intermediate term downtrend at least, depending on how you look at these things. But the problem is when you're in a downtrend, most stocks are also going to be in a downtrend, if not maybe 75, 80, 90% are going to be in a downtrend as well. So that's why this M becomes so critical. And so just to give a brief overview, this is how we approach investing. These are like our three pillars, we call them. And the first thing I think is technical analysis, because a lot of times these stocks move before the numbers, and you just want to, you want to buy a stock in an uptrend because it moves. That's what tells you that the fundamentals might be improving. Fundamental analysis, you can also find this and build conviction in a stock and wait for it while it's in a consolidation phase and buy breakouts. But I think that fundamental analysis, if you understand a company and what's going on, you want to fish in that pond of really strong fundamental companies. Companies that are growing earnings by 25, 30%, or maybe even 100%, because you're just going to have that's going to help you achieve a better batting average if you're buying the best stocks out there. And then macro, which we do want to have a grasp a little bit on what's going on. A lot of times there can be narratives and actual economic developments that drive the market. You can see that regularly. It's been inflation as of late, and now it's been this tariff and uncertainty and GDP or growth concerns recently. So, we want to have a grasp on that outlook without it, hopefully without it clouding our bias too much. But nonetheless, it's something that we pay attention to, although albeit, least of these first two things, because the technicals got you out first. We'll talk about too. That's the thing that got you, would have gotten you out before, maybe more and more news and headlines start piling on about why growth might slow down. So anyways, these are the three pillars. Technical analysis, if we're going to send these slides out. So if you wanted to see what, the important things that we really look at, here's a list of different things. And we'll touch on actually a lot of these today. And trend being the most kind of important thing in technical analysis and just price in general. So this is a good thorough list of things we look at regularly. Fundamentals, we like to just sum it up with this CAN-SLIM acronym. There's obviously a lot more that you can do and diving into the depths of financial statements and everything, but this is a good high level overview and takes care of a lot of the important, the really, really important things, because a lot of times the details aren't as important as as these general, things that can kind of be glaring at you when you find a market leader. Like I said, macro is something that we pay attention to. So I'll go over, basically that's what I'll go over for most of this, as well as some technical internal things that we look at. But this is something we noticed, and it's I'm not sure if everyone has started to notice this, but it's the GDP nowcast from the Atlanta Fed for the first quarter. So we saw a real significant drop in that um, in the last few weeks, and a large part of that revision was because of an imports number going up. If you want to go into the details, but part of our thinking is that we don't really care what's driving it. If GDP goes down in the quarter, and we're at risk of going another quarter, let's say, well, that's a recessionary number, and that's just never good for stocks. I don't see how that shrugs it off. And so now you have to question how much is, if we've gone through enough pain, if we're really going to decline by 2.5% in the first quarter. You first see this big drop. I think everyone's gut reaction would be to question the numbers and the legitimacy of it. It's unclear, right? We don't really know what's happening under the surface, but nonetheless, this is alarming. And if this is a real number and it turns out to be accurate, and consensus is yet to follow, the indexes have maybe not come off enough. So that's what we're wrestling with, I think, and I think what the market is wrestling with right now. And we can pontificate about why and all this other stuff. Why is it happening? Is it tariffs? Is it uncertainty? Because of that, is there an import number increasing perhaps to front load tariffs? That might be part of what's happening, and then later those imports are, we front run all that. Perhaps that's part of it, but I think that the math is the math, and if we're down 2.4%, it's not going to be good for stocks. But I also wanted to throw this out here because you never know. Again, these are all narratives, but most importantly, we'll look at the stocks or the market in general. But this is Scott Bessent, right, the Treasury Secretary, and a comment he made on Friday. One of the things that we could be dealing with is if they actually cut government spending, right? If they're actually making a meaningful cut here, that is deflationary, that is recessionary. Those are all different, those are all negatives to the market, despite what we think. Okay, in the long run, sure, great. More efficient, we're not wasting stuff, there's less fraud, absolutely long term, great. But in the near term, that doesn't matter as much as lower liquidity. And I want to keep looking at the numbers and understanding what's really happening to all that. In the meantime, but who knows what's really going on in the administration. There's a lot of volatility in the administration and what they're suggesting and what they're going back and forth a lot, right? They're saying here's 50%, here's 25%, never mind, we'll push it all off. And that volatility and uncertainty, the market hates nothing more than uncertainty. So that could be just a lot of what's happening, and we just need more clarity. But I don't think there's a clear roadmap at all for the administration at this point. So um, for now, the market has spoken. Okay, just like the market had spoken here when he was elected. Okay, great. Great. The administration is going to deregulate. It's going to be great. And we had a great 6 weeks, right, of market action. Well, since then, it's been a different story. There was inflation scares. There was deep seek news, right, over here. There's a lot of different things. And then we made this all-time high and then completely got rejected and reversed off that all-time high. So, most likely a lot of people, including us, were caught loaded up because to us, a market making all-time highs is the exact environment we want to be fully long in because that's the easiest dollar environment you typically will see a market making all-time highs. But since then, the trend has changed. We broke the 50 right here on volume. We saw, you know, um, distribution days piling up. We saw we're below the 50. We saw this 10-day cross below the 21-day, which is something we always talk about. This large down day here was a sell the news event on Nvidia earnings again. And that's where we took the rest of our entire portfolio off, even everything that was even holding up because I think a lot of people were starting to be skeptical of the gap up on Nvidia earnings and it quickly reversed negative. So I know we finally took the rest off of everything that we had probably in the first 10 or 15 minutes of the market open there. And since then, it's just been a pretty relentless meltdown. And you can see, okay, it's ugly, 13%. We had a 15% drawdown at the low back in August, um, right down here, but then we probably closed down, let's say 13%. So we're in the realm of that, but we just have not let up. And to me, it's unclear. And we'll talk about why. Okay, the trend is down, sentiment's very bearish, but then there's a couple other indicators, several other that are other sentiment indicators that are not spiking that I think are more relevant than just this AAII bull bear sentiment that people have probably seen lately. Also, just including this, thought this was fascinating too. Really steep drawdown in the IBD mutual fund index. These are and it's an index of 20 mutual funds and that are real top performing index or mutual funds. And we follow them. We like to see them, under the institutional sponsorship tab of Market Surge. So, they're seeing a lot of pain with this most recent drawdown too, since mid-December. One of the things about these index or these mutual funds is they have to be 100% long. So, that struggles, right? Or that's a difficult thing for them. So, obviously we advocate for having an exit strategy to avoid these big drawdowns. But these top performing, fund managers are not doing very well either uh, of late. And then lastly, I'll just point out the FFTY. Same thing as the mutual fund index, a big drawdown. We call it the barometer of our strategy. And this has been quite a nasty drawdown in these indexes or these stocks as well. And more context, although I don't know if it adds a whole lot, but of course in this risk off environment, let's say XLP versus the S&P 500, that's consumer staples. So consumer staples outperforming for the last 2 months now. This is S&P versus bonds, so the S&P or just the stock market underperforming substantially versus bonds. And then growth versus value, same thing. Growth stocks, just like the FFTY, getting crushed. Um, but just and wanted to include this. And one more kind of talking point that we just maybe you saw this too if you're very active on Twitter like we are. You saw the comments perhaps around a few people sharing these charts. Um, why do you not get out? Well, why should should clients just stay in, it'll come back. You're selling at the wrong time. Um, and the sort of old Wall Street advocates buy and hold because if you miss the 10 best days, this is your performance. And this is like a 25-year, 27-year historical performance. The red line, being what happens if you miss the 10 best days? Uh, and that's why they say don't get out because, then if you stay in, here's your performance. It's significantly better, right? It's over twice as good if you just miss, if you just stay in versus missing the only 10 best days. And, of course, the 10 best days, they cluster around the 10 worst days. But if you just somehow can time it perfectly and you miss the 10 worst days, um, it's much more important, right? Basically, the benefit of missing the 10 worst days far outpaces the benefit of missing the 10 best days or the detriment of missing the 10 best days. So, the point is we like to we're willing to miss those 10 best days because we're missing the 10 worst days as well. Because those 10 heavy, strong days they always happen in a bear market. You don't, there's something horrible going on in the market if you're seeing, 8% move in the index. So, we think there's times to be out, and this is certainly one of them. And this is something Richard Moglen shared. He was talking about that because he saw the same chart being shared about missing the 10 best and worst days. He took it a step further, actually, and he looked at 25, right? 25 best and worst days, and he went back really, really far to 1970. But what he did, also what he added here, was this navy blue line where he says, okay, let's assume, since we know they're usually back to back, right? The worst day happens next to the best day because the volatility is insane. What if you just avoid all of it? Well, here's your return, and that's better than the buy and hold, too, by a good margin. So his point is, right, if you can't time it perfectly, which is ridiculous, right, an insane assumption, if we can just sit out, also, there's a benefit of that, right? So we're in this sit out mode, and we're comfortable doing that, and not necessarily, guessing if today is going to be a down 4% day or up 4% day. If you just avoid these treacherous market environments, the benefits are still there. So that's why we kind of sit on our hands during high volatility markets. Um, let's see. Okay, I just included the 10-year. I don't have a whole lot to say about it, but it's gyrating. There's some things too, these narratives out there as well, if you're paying attention, that Trump wants the 10-year to come down. And Scott Bessent has specifically cited the 10-year Treasury yield, saying he doesn't care what the Fed does. He just wants the 10-year to come down. And which I think, that's a much more logical thing. It's a market-based indicator, right? It's much better than the ivory tower Fed people dictating where interest rates are. Um, it's nice that he defers to the market at least, but anyways, he's talked about this, and there's some like maybe conspiracy theorists or narrative people that are trying to say we've got a lot of debt to renew or refinance, I think next year or this year, I can't remember. So anyways, that's why there's maybe some urgency to bring rates down and then refinance at a favorable rate. But who knows? Again, I don't know. I don't know if I want to give Trump that much credit for playing 40 chess in that regard. I really don't know. But we'll just get into a little bit more macro too. Here's the CPI. We know that's tomorrow. I think CPI continues to come down. It continues to be less and less significant. I think it continues to be pulled down closer to 2%. The PCE, which is the Fed's preferred measure, is a little bit lower than that. I think in February the PCE is going to be like 2.5, and then in March it'll be like 2.1. So, that's 2%. I think it's just about done getting talked about. And you can see growth is anyways becoming more of the concern right now. And just adding again, core CPI, this is why it's going to come down. Very, very slow moving thing, very lagged in the way they've constructed this. It's going to come down to 2%. It's on its way there right now. Um, and it's just a slow moving indicator. But one other thing you can look at if you care is true-flation. We haven't looked at true-flation in a long time. We were looking at that a lot, I think, in 2022 when inflation was coming down, and that was a much better real-time indicator in 2022. Um, but someone reminded me of that resource, and it's a very cool resource of alternative data to give you a real-time look at inflation. And that'll tell you we're already at like 1% on truflation, and I believe that more than I believe this data. Um, so that's something to keep in mind. It's just this doesn't matter anymore. What matters is what's going to happen with fiscal policy, I think, at this point. And so, the I guess the scenario we could be in, and we'll look at the chart of 2022 versus 2025, but it's possible 2022 was the monetary policy recession, and 2025 becomes the fiscal policy recession. Either way, get it out of the way because we saw what happened in 2022 when we had two negative quarters of GDP in a row. When we had that recession, it was induced by the Fed. This one could be induced by, Congress, the president, and all that, and Doge. But we will see. But anyways, we'll keep going. Here's a look at the 1 and 2 year Treasury rates. Just it's sort of a blended yield over the next couple of years. So it tries to sort of project the path of Fed funds indirectly in these rates. And so you can see the 1 and 2 year are falling now a little bit. They've come down, 0.4, 0.5%. And so that's what that's signaling is, this Fed funds path. The Fed funds futures are pricing in a much different environment at this moment than they were pricing in a month ago. So this chart looks at the predicted Fed funds rates over the next 7 meetings, so to the end of this year. And a month ago is this green line. So we were expecting much fewer cuts a month ago. A week ago, we were at this red line. So, clearly a little bit of a shift in 3 weeks. And then in the last week, we've continued to decline. So we've continued to see more expectations for Fed rate cuts over the next 9 months. So, that arguably is coming from that deterioration in economic outlook recently. So, it's nice. I mean, it's not necessarily nice to see this adjust because if, a lot of times if they cut, it's in an emergency situation and things like that. But the fact is the bond market is sniffing out something here. They're sniffing out probably a combination of slower growth in the immediate term and lower inflation. Um, so, I find this interesting too because I'm sitting here trying to think, do I trust the Doge numbers? Do I trust that they've really, saved 200 billion already? Are they really, in 2 months or 2.5 months? Or is it sort of, and fluffing up the numbers, whatever. But, if rates are coming down, I think that's telling you maybe these are, those are real numbers. Or it's tariffs. Again, that's just causing issues. So anyways, it's hard to speculate on what's really driving it, but the fact is things are changing and they've changed kind of rapidly recently and you can see it in this Fed funds path. Okay, and I want to go through some sentiment things too because this we had this big spike in the AAII sentiment of bearishness in I think a week or 2 weeks ago. So it was like 60%, 62% were bearish. People were bearish. And so I wanted to go back in history, of course, and see, well, that's a really high number of bearish sentiment. So what other times did we have something north of 60? And what did the market do? Naturally. So this is going back at 1990. And you can see where this is the bearish sentiment down here in the red line. And maybe I should just point with this. Yeah, the bearishness right here peaked. And that was extremely timely for a market bottom, right? So that's, something that's, I think, noteworthy, absolutely noteworthy if you have this, huge spike in sentiment and a meaningful low in the indexes. And then same thing here in 2009, March of 2009, we had a spike to 70% of bearishness. And you can see, of course, wow, what an ugly, ugly bottom that is. But that happened to nail it, right, in that same week, absolutely nail it. So something, again, that tells you, hey, be on alert to be ready to flip bullish. And then here's 2022, which was another time recently that we had that spike in bearishness above 60%. Now, in this particular instance, you'll see that, the market continued to melt down maybe another 10% from there. Let's say 4,000 to 3,900 to 3,600. So, not as glaring of a, bottom right there, but close, right? Because, you know, that is significant. That 60% level has been significant in the past. And then here we are today, where we have that spike in bearish sentiment to north of 60%. And what's interesting too is that happened right here. We were at the 50-day, essentially on the S&P, and probably down 3% from the highs. When I see that, and it's just unbelievable, right? To think that you can have that much bearishness, unless it's just extremely crowded in certain things. It's possible that everyone was in Nvidia and everyone's been in the Mag 7. And so the sentiment maybe has come off, extremely fast while those stocks have gotten hammered when this diversified, more diversified S&P has held up pretty well. So maybe, that's why the sentiment has gotten so off because people are feeling it more than the index shows. But, this is interesting. And even since then, now it's been a couple of weeks, and we've continued to melt down. But, this is something it's interesting. Okay. So it's an anecdotal. It hasn't been the right timing thing yet for us. And one thing I'll point out now is why I think, I don't want to put so much weight in just that sentiment survey because the VIX is telling you something else. This is not a massive spike in the VIX. We haven't even hit 30 in the VIX, right? The fear index here. If we want a good low, we want to get into the 30s before before we say, hey, this is, they've wrung everything out that they could to the downside. So this is conflicting to me, right? This is, when you have a top 5 type of AAII sentiment, I expect to see the VIX somewhere near the top 5, level. But that is clearly not even close to the case where we're still in the 20s, despite, now being down 13% from the highs. In the Qs, that is. The other real money, money sentiment indicator we look at is this put call ratio. And I don't have the one for today yet. I don't know if it's out yet. But as of yesterday, what you can see is we're still at this 0.9-ish level on a 5-day moving average. And yesterday was the worst day of 2025. So, to me, I'm thinking, why is no one? So everyone's saying they're bearish, but everyone's buying more calls and puts still. That's not good in my, that's in the we go lower column of things because there's not real fear in this or the VIX at this point. People are also, by the way, I've heard some comments about put volume being as high as it's ever been. I don't really care if put volume is extremely high if call volume is also extremely high. I think that is a misleading data point that I've seen shared for people that are hoping and begging, I think, for a bottom, a good low to be set here. Um, but to me, this is extremely neutral, if not slightly, this is leaning complacent, right? It's not complacent necessarily, but it's certainly neutral at best for the put call ratio. Okay, and also, we look at this on sentiment, and this is a survey too, but it is, it's a survey of what real money people are doing, what real active managers are doing. It's more quantifiable than just are you bearish or bullish. Um, this is that active investment management survey where they see how long active managers are. Right now we're at 75%. To me, that's pretty neutral. You can see when we get into bear markets, we hover and live below 75. So we're at a level where, if we break below that, it gets more serious to the downside. But 75 to me, again, it's neutral in my view. So, this is fuel. This is fuel for the bounce. That could easily happen as well. Because we are oversold, and we'll look at those oversold metrics. But again, another indicator that to me is very neutral compared to that just sentiment survey. This is something I'm continuing to look at and update on a weekly basis for myself that I've gotten turned on to by the crowded market report and geez, I can't believe can't think of his name right now, but the guy at Crowded Market, Jason at Crowded Market. Anyways, what this looks at is futures positioning because they report this data every Friday about the Monday data. So they do this every week. And so this is representing last Monday's data. And basically all you need to look at is extremes on this, just like any sentiment indicator. You look for extremes. Um, the red is the commercial positioning. This is what you might consider, I guess, the smart money. The blue and yellow are the speculators. And so when the blue and yellow become crowded to one side, the hedgers or the commercials are crowded the other way. And so this is NASDAQ futures positioning, saying that we're still relatively heavily long in the NASDAQ stocks based on this futures data. So anyways, it gives you some kind of measure of risk reward too, which, to me, if I were to rank you know, this out of the last three things, this is maybe the most negative for NASDAQ um, price going forward, based on how short commercials are here. But anyways, I encourage you to look at his stuff on Twitter as well, and he's got his own service. So now after sentiment, we can talk about why, what we're looking at to say we're oversold. Um, and why, look, a bounce could be imminent, but geez, it's been hard. And, if maybe you're trying to play the bounce, I don't know. It's hard. We're not playing it necessarily for clients until we get a certain, probably extreme measure. But in the short term, we have this NASDAQ percentage of stocks above their 20-day moving averages. And so you can see we're at 19%. That's a very, very washed out level. This has been a very steep decline. And so the fact that we're sitting here at 19% that's an important level that we've seen over the last couple of years. And if they had this data point longer, which they don't, I'm sure you can see that, in bear markets, it gets somewhere like 5% above the 20-day. But so, if you're on, we can absolutely be on high alert for a big snapback rally at any point. Um, but overall, the trend remains negative to us. But the point is, we're on the lookout, sure, for a oversold rally. This is the NASDAQ stocks above their 50-day moving average. That's at 21% as of today's close. Again, approaching levels that are very oversold based on this. You can't get much lower. Um, that's the question. The question is, okay, clearly we're getting ready for an oversold bounce, but how do you do it without getting there early? Um, And I personally, I don't have any interest in being early and being wrong, um, because the next 5% could be extremely volatile. But anyways, here's the Nasdaq in stocks above the 200 day. Um, Here we're at 28%. We've been talking about this and, taking note that, okay, this has not even gotten above 50% for the entire bull market, really, which has been pretty crazy that we have just not had an extremely healthy bull market. Or maybe we've just had a lot of these crappy IPOs that have just continued to fall and fall and fall from, to $10 to $5 to $1. Maybe it's, a bunch of ghost companies from the COVID boom still that are, still living below their 200 days. I don't know. But anyways, this is coming off. It's at 28% of stocks above the 200 day. That can go lower, of course, to 10%. But anyways, all these sort of things are saying how we're getting quite washed out. We're getting oversold and we're staying oversold. Okay, so that's been an issue that we've dealt with. I don't know, I'm sure some of us have sat there and tried to play the bounce occasionally, um, and maybe you've gotten lucky a little bit. But the next day, after a 1 day rally, the next day we're taking out the lows and going lower, and so we've been oversold based on this McClellan oscillator. We've been oversold since like February 24th or so. So it's been 2 to 3 weeks of just staying oversold. And there's that saying, if markets crash from oversold levels. Um, so that's just, again, that's why you just have to be careful. But yeah. So I mean, look, we are oversold on these indicators that we all look at, but it's just dangerous. And then, I talked about, I'll just circle back to what we talked about, missing the best and worst days. I found this fascinating, right? Just looking at these top 10 and worst 10 days, uh, just the magnitude, right, was incredible. Um, so just a reminder of what you might see. And, I'm trying to imagine, in October of 2008, as an example, you've got a 12% up day. There's going to be power if something, if something were to transpire that becomes worse. But just keep that in mind. You're going to have powerful up days around significant, these significant down days. And, sure, you can try your best to, if you're an excellent quick trader, you can try your best to time these things and maybe get a couple of these bounces here and there. Um, But, ultimately what you can do is simply wait for the trend to change. There's a couple of things, for us, as an example, the trend could change before we're above the 50-day moving average in the indexes. We might look for the 10-day to cross above the 21-day. Um, that to be the first step in the right direction. We might look at the MACD to have a negative divergence. So the MACD goes on a buy signal while we're turning and trying to bottom, um, versus trying to guess through all this volatility. You're more likely to get chopped up than not. So you know for now, I think the trend is just going to remain your friend. Okay, so keep that in mind. We will talk about some stocks, of course, regardless, and we can talk. We'll, get some suggestions from you guys what you're looking at. We're always looking for relative strength, um, and everything like that. But anyways, just I thought this was an amazing table, and clearly you can see how it's all clustered around 2008, 2009, 2020, right? uh, in this day in 2011. But yeah, the fact is, man, volatility begets volatility. So um, just yeah, tread lightly for now. Oh, and I threw this in there too. Another shout out to Crowded Market Report. This was interesting to me because he shared this chart too with the futures positioning about the yen. And so if you remember back in June and July, a little tidbit, right? June and July, we know we had a huge net short position in the yen, right? And there was that yen carry trade unwind that then that created all this volatility in equity indexes across the world. So this was when the yen was extremely crowded short by speculators. Now the yen is apparently extremely crowded long. and you can say, okay, this is the extremely high risk off trade, right? The yen is notoriously a risk off currency, just like the dollar typically is. And this is actually the most long that the data has ever shown for the Japanese yen. So, anyways, if you are into currencies, which we're really not, one of the things that would be if you wanted to play a risk on scenario, one thing to do would be shorting the yen based on this data. I thought it was pretty interesting, again, just because it's the highest in the data set, which was like 25 years of data, to see how crowded long now the yen had become. So, anyways, an interesting shout out to end on, I think. And with that, I'm gonna end up turning it over to Roy for stocks and hand it over. But perhaps we can go through a couple questions if there are some too. Roy, did you see some good questions on?
Wes, do you use high yield bonds, junk bonds, JNK as an indicator for the condition of the markets on a macro level?
Yeah, we definitely do. And if you've seen before, we look at the high yield spread. We've been looking at that more. And what's funny is, of course, when everything's good and hunky dory, and stocks are working, and 2024 was just fine, and now everyone wants to become macroeconomists again. Um, but yeah, we look at that because the high yield spread is really just the inverse of J and K, and I like to look at J and K because you get real time, intraday pricing. So that's great. Yeah, you can see that coming off. Finally, and what's interesting is those held up pretty well um, up until today, right? I think J and K is just hitting the 50-day. Um, so yeah, we'll see if that's always that's the next shoe to drop in certain things, right? When the economy weakens, you can see it in the data, and the next shoe that can often drop is like a credit thing, right? Um, so we're keeping our eye on it. I don't know. What do you think? Do you have any thoughts on it, or are you just flagging it because you saw it kind
No,
of maybe
I
start to
do watch
decline?
it from time to time. And I look at it, and during bear markets, it always seems to roll in sim like neck and neck kind of thing, you know.
Yeah,
I
yeah.
know
And
it.
again, it has held up because there's that treasury yield component right. It's the treasury yield plus a spread. So the treasury yield coming down has probably supported it to this point, right?
Mhm,
Um, and now maybe you see the spread now expanding perhaps a little bit.
mhm. No, I'm not 100% familiar with it, but I know it's just
Yeah.
they say it's an indicator that once that rolls over, then it's an indicator of more of a worse case scenario for the market, I guess.
Yeah, and it's still low, and I'll show you the spread too. I shared this little thing in the hopefully you guys can see it and download it. I just shared it in the chat. This is the chart we look at, that high yield spread. Um, and again, that's like that credit risk spread that's increasing, while J and K is decreasing here. And so you can see that finally start to perk up, because up until mid-February, while the index, well, stocks started acting poorly, we didn't see that pick up. So it makes sense that it would, be starting to turn up here.
Okay, thank you, Wes. I'll take over now. What do you guys see on your screen right now?
Oh,
Yes.
AIQ. That we see
Okay,
AIQ.
good. Okay, good.
You
Okay,
can make
thank you,
it full
Wes.
screen too, by the way. We see the browser behind you.
That better?
Yeah.
Okay. Thank you, Wes. As noted, Wes is battling the flu, so we wanted to thank you, Wes, for showing up tonight and leading the beginning part of the presentation. Hope you feel better.
Thank
Okay.
you.
Okay, so I wanted to just go over a couple of charts that really show the context of where we are in the market cycle, and also to show you why we're 100% in cash in our core and swing trading accounts. Now, the way that we define an uptrend is we define an uptrend when the 10-day EMA is crossing above the 21-day EMA, and the 21-day EMA is above the 50-day simple moving average. We also define us either being in a long-term uptrend or downtrend based on where the 30-week moving average is. So from our work going back decades, we have seen and shown that if you close 2 consecutive weeks below the 30-week moving average, that you're really in a stage 4 downtrend, the beginning of a stage 4 downtrend. And you can see that's kind of where we are positioned on the chart right now. Now, we don't know when you're in a downtrend like this, when the market's in a congestion period, no one knows where the bottom is. You can run Fibonacci retracements. You can look at prior corrections in the past. You can use point and figure counting methodology to project, where the correction will end. But really, no one knows, and that's why, in many cases, just following the trend is your most effective measure in determining if you should be in or out of the market. Now, granted, you're going to have whipsaws that take place. You're not going to have any methodology that's 100% accurate at all times. But this is just something to have in your tool kit so that you can know whether or not you should have a lot of risk on or risk off in your portfolio. So you can see that we have corrected 2 weeks below the rising 30-week moving average, but we're sort of plateauing out. But note the difference where we've been in this uptrend for over 2 years, where we got down a couple of times right there below the 30-week moving average, snapped back right there in that was October of 23, and then again last August. And when you go back and you look at on a chart like this, it sort of puts everything in context so that you can see everything. So we're in a really defensive posture right here. We're in a dangerous position because we don't know where we don't know where the economy is going. We don't know how tariffs are going to impact the economy and impact company earnings. But we do know that it is affecting consumer sentiment. And as you know, 70% of our economy is based on consumer spending. Well, the consumer is slowing down right now. You can see stocks like Costco and Walmart that they're telling you that. And it's been corroborated by that Atlanta Fed report where GDP has been revised lower to minus 2.4%. And this is the first time that it's happened like that in recent memory. I can't remember over the past 3 or 4 years when we've had a revision downward that way. Now it's just an Atlanta nowcast model. So we'll just monitor that it comes out, weekly as well, or when they make a change. So that's something to be aware of. And looking back, if this market morphs into a bear market, and we're not saying that it will, but the trend is certainly negative right now. But that's going to be one of the things probably if we're in a bear market, 3, 6, 9 months from now and the market's lower, that you're going to go back and see, well, the Atlanta Fed GDP model was telling you that. It was warning you that the economy was going to slow. It was warning you that we were going to potentially go into a recession and so forth. Now, there's some confusion in terms of what market participants say in terms of if lowering interest rates are very bullish or bearish. They're bearish when you go into a recession. All you have to do is look at 2002, 2003 2007 to 2009 when the Fed finally cut and the market went 40% lower after their initial cut. So you have to be careful. You've got to be careful to just think that, okay, the Fed's cutting rates and the markets can go up. But, be prepared for, tremendous volatility when you see Powell talk about that. Now, he's going to be talking next week. And so there's going to be quite an audience that will be watching his remarks very, very closely to see if he talks about lowering rates, because last Friday he was on and he said the economy's doing fine. So something's not jiving right now. So just be careful of that. So this is the NASDAQ. You can see we're below the 30-week. And, when you go back and you look at that 2022 bear market, it all started when we broke the 30-week. And let me just change this date. See, it all started when we had this nice uptrend and you broke the 30-week. That was the time, and no one knew that we were going into a bear market. It just looked like a normal correction, but the trend break right there alerted you to be careful. And, again, we've got 2 straight weeks below the 30-week. So it's going, in our view, it's going to take a little while for us to repair the damage. And, there's going to be quite a bit of volatility and back and forth action right now as the market tries to figure out, all Trump's policies and earnings and companies' outlooks and things like that. But remember, with all this volatility that we're going through right now, earnings are only 6 weeks away. So this is going to be an excuse for companies to revise their earnings downward. Probably you're going to probably see some negative effects regarding the language of tariffs and things like that. So you've got to be prepared, and that would be the catalyst that would probably project us to make a new low after a consolidation period. Now, it's true that we're about 3 ATRs, that's average true range, below the 21-day on the NASDAQ right now. And so we are highly oversold, and we could start and begin a rally at any time. But the question is, how do you want to play it? Because you only have about a 5 to 6%. If you nail this bottom like today's low, you only have about 5 or 6% really upside on the bounce in the averages anyway, to participate. Now, some of these stocks that have been crushed, and just pick your name. I saw someone mention Reddit earlier on the chat. It could be Reddit, it could be Palantir, it could be Robinhood. You can pick any of these stocks that have been hammered, and those most assuredly they're going to bounce pretty significantly on the bounce just to recover to the mean. But you've got to be very, very careful and respect the upturn, the bounce, and then the resulting rollover and the downtrend that might ensue. So this is the NASDAQ. So I just wanted to point out that to you. Let's take a look at the S&P 500 and look at the same context. The S&P 500. And this was the bottom, see, in the bear market top in 2022. Notice the nice, and this is from the COVID bull market, where we turned and had this amazing move in the bull market above the 30-week, and then the resulting rollover. Look how choppy it got. See, look how choppy it got at the top in the S&P 500. So this is a very, very difficult time to make money when you have this volatility, these tremendous swings in the market. I'm going to show you a couple of instances in the past really to temper your enthusiasm, thinking that, okay, we're off to the races again. We're definitely in the camp that we think a bounce can happen in the market, but we think it's going to be met with selling. And if we get a bounce up to the 21 or 50 day, we will probably short with indexes. And that was our game plan coming in this week, but we never bounced. So now you want to see a bounce back up, see to the 50 day, the way you had to bounce, or the 30 week, the way that you had to bounce right back here at the top. And when people think that, oh, the danger's passed, the danger really hasn't passed because the chart is broken. And, I remember in 2022, we were out of the market about 9 months. So it was very, very difficult to trade a few, a couple of week swings that were met with, intense selling. So just be careful here and use that 30 week just as a guide post, if you will. Let me bring that back to today so that you can see what that looks like today. 325. So again, there's the look, which is somewhat concerning to us. It's very, concerning to us. So we would, it would not be out of the question to bounce up for a week or two, 4 or 5 days, 5 to 10 days. But, we do have CPI coming in tomorrow, and PPI or the price inflator expenditures index deflator index is coming Thursday, I believe. So we have, two major economic reports that are staring us in the face. So I wanted to point that out to you. And I also wanted to show you just a few illustrations in the past, and I'll just use the NASDAQ here. And you can see this is a market surge chart. So you can see the 10 days below the 21 day, 21 days below the 50, and we've got a rolling, a rolling 50-day moving average, and we are below the 200-day. So, you've heard the adage, nothing good happens under the 200-day, and that's where we are right now. So we would expect a bounce anywhere up to the 200-day or the 21-day, and then a consolidation and a rollover from that particular level, followed by a move taking out the recent lows here. If we get a bounce, if we get a bounce 4 or 5 days back up again to this green line or the magenta line, we would expect this to roll over and actually undercut this and make the next leg down. And that next leg down, if we don't have capitulation with the VIX, where we got very, very close, but we didn't quite get it today. But if we don't get it, we'll probably get it on that next leg down. So this is what you have to contend with. In terms of managing your portfolio, you have to treat any activity and any long exposure as a trade, not as an investment. In the current environment that we're looking at today. So just be aware of that. So let me show you a couple of dates that I had in mind, going back to 2011, 2012. And I wanted to point out, and this was back in 2011, where we made this, this top looks very similar to what we just experienced on a more drawn out basis that we just had on the NASDAQ recently. And we broke the 200-day quickly. And then we had the waterfall move down, followed by, look at this volatility here. So, this is the kind of volatility that you might expect, over the next, 4 to 6 weeks. But, until you convincingly get back over the 200-day, it's really, you've got to have a very, very short-term outlook. Look, for every movement up of 3 or 4 days, you gave it all back in 3 or 4 days. So that's how choppy it can get. And, if you happen to be on the wrong side, you can really, really do some damage in your portfolio by just getting chopped up, trying to establish, long positions, and then immediately immediately, selling off. So that's going to be not just frightening, but that can really hurt your investment portfolio's actions as well. So this is the type of activity that we expect. So we're going to be very, very careful in terms of adding exposure in the environment today. And if we put anything on, it's going to only be for 4 or 5 days, maybe 3 or 4 days even. So that's what we would advocate currently. Let me show you another. Let me change the date. Show you another similar type situation. Going back 10 years ago. Same type of situation where this is in 2015. This is in 2015, and actually, this is some of the stuff that we had annotated before in terms of selling, buying, and so forth. So we had the big break quickly. We had this mini flash crash, and look how quickly it occurred. And then look at the ensuing volatility as well. See, this is what we expect. We didn't quite today have this type of waterfall effect, but notice where you had the break, you moved up to the 10-day, consolidated, move up to the 200-day, that was met with selling, and then this type of volatility. You had a tradable bounce here that lasted, about 4 weeks from the bottom to the top. By the way, that was a follow-through day right here that I indicated right there. A follow-through day, it's a day, coming off of a correction that's up more than, we typically use 1.25%, 1.5% on higher volume than the day before. And so you had the follow-through day that worked, and you had a little tradable rally. So what would you look for in terms of how do you know when to get back in the market? Well, there's certain things that you should be alert to. You should be alert to a follow-through day. And notice the follow-through day doesn't come on, right off the bottom. It comes later when the, when the damage has done and stocks have finally based some over the course of 3 or 4 weeks. So we would expect, time that needs to be necessary to heal these broken charts. But you would want to see a follow-through day. You would also want to see some divergences in momentum. In other words, while the averages go down, you'd like to see the breadth increase when the averages go down. You'd like to see the breadth expand and increase. That would be very, very useful and important. And you would also like to see, as a confirming signal, the crossovers of the moving average back to the upside. So you can see in this particular case, you had a crossover on the upside in the averages, just as you had a crossover right there on the downside on the movement, which led to the movement below. So this is how choppy it can be. And I had one more example that I wanted to show you. And basically what we're doing is we're trying to get you to take your pitch, wait for your fat pitch, and not be so aggressive that you come in with firing on all cylinders to try to make back any money that maybe you had lost. You want to wait, be patient, and wait till the environment's better. Another example, this is that 2018 bottom, and you can see we had the sell signal breaking the 50-day. We broke the 200-day, you bounced back up, and then you made another leg lower. And so again, this is the type of environment that you can expect. So it's going to be very challenging, particularly with earnings coming, particularly with the uncertainty regarding the tariff wars, the trade wars. And I think Trump he's gotten guidance from his cabinet. And just as any the first year presidents do, they want to take all the medicine up front so that the back end of their presidency is more successful. So I think that's what he's doing. He's embarking on with all this rhetoric that's clearly driving the market down, creating uncertainty, and he's just getting that he's getting that out of the way. And he's before he's often commented that he uses the stock market as his barometer how his presidency is going. I think he's got a different tactic this time. And so that's going to lead, I think, it's going to continue to be news driven, headline, driven news. And it's going to take, it's going to take some time to wash out and discount all this rhetoric and all these crazy, all these crazy policies, such as, wanting Canada to be a 51st state and things like that. There's no way that's going to happen. And this is just his way of negotiating. And you can see when he kicked Zelensky out of the office, 10 days ago, because Zelensky changed changed his view. He was supposed to come in and sign the deal and then move on, and he used it. He used that to get in front of our press, say some very fiery things, and Trump threw him out. And then you can see that Zelensky came back, and now they're negotiating right now as we speak. So, by the way, that's what also created the market move today. Is they signed a ceasefire. So you got Ukraine, the Ukrainian people, Russian people. They signed a ceasefire. That's what led to the sharp bounce. But that bounce was met with selling as well. So just keep that in mind. So that's a little bit. That's a little bit in terms of what's happening in the market today. Expect to move back up. If we don't get a move back up, if we have negative news with inflation, wouldn't be surprised if the next move down is to 16,000. And again, those IBD mutual fund, which is hundreds of billions of dollars of the top managers in the country, they're down 19.7% today, year to date, which is that's unbelievable from the top there. And you would expect another move down in those funds if things get really, really dicey. And I would not put it out of the. I think it is quite possible, but even if we put in the low today, it's going to be very, very choppy. So just keep that in mind. So with that, I'll answer any questions that you guys have. And by the way, we normally pull up, stocks that we own and go over them, but we don't have any stocks. So we're going to just open the floor up for you guys if you want to just talk about stocks, or if you want to comment on, on the market condition. And there's one more thing. I saw this on Twitter. I have this annotated. This is a power trend. This isn't a buy signal or sell signal. This is merely a condition that Mike Webster and Justin Nielsen and Charles Harris developed in terms of where you should be pressing the pedal on margin or not. It has nothing to do with this isn't a buy signal or a sell signal. This is something that they developed over, looking back historically over many, many decades to demonstrate when you should be off of margin. So this is the time you can see in these uptrends when you you add big margin, but of course when you break, when these power trends end, then that's the time to be off of margin. So certainly you don't want to be on margin if there's a waterfall, development, waterfall decline like we just experienced, or you would have, had your head chopped off. So you can see back here. This wasn't a sell signal necessarily. It was for us because of the break and the action in leading stocks, but that was a signal where the 20, where we broke the 21-day crossed the 50-day on the downside, and that's when the power trend ended in this case. And you can Google that, Google power trend for IBD, and you can see a full explanation of that. But just wanted to point that out.
Hey, Roy, I do have a question for you.
Sure.
So you've talked about this bounce a lot, and obviously there's so much carnage out there that yes, maybe there might be a bounce and then we retreat south again. But my question to you is, professional traders, how do they play that bounce? Do they play it with individual stocks, or do they play it with the indexes like the Qs or the SPY? Or is there an ETF in particular, like the momentum ETF, which is the best way to play the bounce? So if I was looking to do the bounce, what would be the best vehicle? And do you do a leveraged ETF like SPXL or TQQQ, or do you not leverage the bounce?
Well, this is, if you want the more, in my view, if you want the most leveraged, aggressive way of playing it, this is the this is an ETN, an exchange traded note, and it's based on 3 times the New York Mag 7 index. And this is, you can see where this dropped from 690 to under 400 in the recent sell-off. So it's down 44%. So it's down 44%. This would be the most aggressive way of playing it, using yesterday's low as a stop. And if you take that move to the 10-day or the 21-day, and that move to the 10-day or even the 200-day, that's 20%. So, where you might only have, like on the Qs, a 5% rally, you've got a 20% potential rally in something like this. And if we would rally up to the 21-day, that is 25%. And that's going to happen, this can happen quick. If we do get a reversion to the mean trade on the upside. So this is the most aggressive way to play it. FNGS is in that same ballpark. This is the same kind of thought. And of course, the TQQQ. I'm showing you the most aggressive way. So the move up here, see, this doesn't look like to me that it's going to rally all the way to the 200-day. It looks like the rally may only take you to the 10-day. What's the rally to the 200-day? The rally to the 200-day, 20%, 21%. So that's, these are the most aggressive ways of playing it. And you can, like for individual stocks, this was mentioned today. And you had this move all the way down from 230 to like 130. And this was up $15 a day, up 14%. So, you could have bought this guessing at the 200-day. Yesterday, it closed at the flat bottom, and the trades can take you right there to the 10-day on this one, which is 15%, 15% trade. So don't think that we're off to the races on a new bull market, but you do have these trades that you can play. Here's Robinhood from 67 all the way down to 38, 35, and the trade takes you back up here to say that rolling over a declining 50-day, and that takes you to that's 25%. So in Robinhood, you can do Palantir. And these are all stocks that we owned and that we owned before. And we, of course, stopped ourselves out, 3 weeks ago. Palantir takes you back up here to the 21 day, that's about 12%. So you really can pick any of these stocks, but you do have individual stock risks where the indexes are going to provide you with just market risks, not individual stock risks.
Roy, would you think so when we do get that bounce and then we proceed to retreat again, wouldn't you say your best RS starts to show up at that point? Like for in terms of stocks, like there'll be stocks that won't participate on the le second
Oh,
leg.
absolutely,
Those will
absolutely.
be your stars that are shining kind of thing, you know?
Absolutely. And I was just going through, Wes and I are sort of talking about this, and this is a stock that IBD wrote about. I think they actually have it in their leaderboard portfolio. I've been watching it. There's the earnings report right here and this is a biotech company with a multiple sclerosis drug. And you can see where the stock's got a 98 relative strength, broke out to all-time highs, and you can see earnings are estimated to be 560% this year, 95% next year, and you're going to want these are the stocks that conceivably can go up, in a bear market or in a bad market. It's just very, very difficult, but they are going to show up, like a sore thumb. So again, you want to be screening the stocks with the best relative strength, and we are seeing some biotechs that are holding up that had good earnings. There's an earnings report on this. This is a gene editing firm company with a 99 relative strength, and $87 price, and the next move up takes you right there. If you get through this congestion, take out that 115, you go to 150 on it, and look at the earnings numbers. So you want to screen stocks, and we're in the process of doing this, screening for the companies with the best earnings that have the highest relative strength. And again, you can probably get a bounce. You can get the biggest bounce on the stocks like Reddit and Hood and Palantir, and you can just go down the list that have been clobbered the most, that were the leaders. But then you're going to want to turn to determine, well, who are the leaders? The next leaders in the market.
Through screening, I found that pretty well any insurance stock out there, the charts look immaculate, like the
They
perfect
do.
cover.
So
And
it is.
is that like a Fugazi thing? Like when the market, when growth stocks come back, will those things like basically are fall apart, or will they, or is that to be trusted, or like it feels like that might be a place where money's hiding out, you know?
It does, and that's because you don't have explosive numbers. You can see this, Aon, this insurance company, earnings can be up 10%, 12%. Not the explosive numbers that we see on your typical growth stocks, but they do have great patterns right now, and you can just go across the list. All the insurance stocks look, great. And so that's going to be interesting to see how, again, how that shakes out. But, again, you had, look how, this is how things change so quickly. And Walmart was, leading, and, this was sort of a defensive play. And, earnings are fine. Look at earnings. Earnings were, next year they're going to be up 5%. And 2025 they were up 10%. But it was a place where people were hiding out, and then there's the break finally, and it turned over. So now this is it's a broken chart, no place to hide. So I think you're going to see it's quite possible that all these stocks, like the insurance stocks, we'll just see. But I do think it's sort of a place to hide because the numbers aren't explosive. If you have these stocks with the same type of numbers that rolled over, I would expect, I would expect the insurance stocks to roll over as well.
Mm.
How long do you think this market rout can last? A year or until summer?
There's absolutely no idea. It's a matter, I guess, it's a matter of if we do get washed out. If we do get washed out quickly, it could be over. I was talking to a client a couple of weeks ago, and we were talking about it. And I said maybe this market might wash us out in the next 2 weeks. So we're right there on that time frame, but we're just not quite there from being washed out on an anecdotal basis yet. The anecdotal evidence is still not quite there. It's close. It's very close. And since we're in our portfolio is 100% in cash, we would like this market to come in and get it over with. So we're close, but these stocks have had tremendous moves down, and you must take a look at what might be possible. For example, if you go back and let's take a look, let's go back to 2020. And this is something that we are taking a look at, because not every market is exactly the same. But this is in 2020. So this was a leading stock, Shopify, made a new high. The stock had doubled. You had that nice uptrend. Then COVID hit, and let me just go out and show you sort of what this looked like. And we actually bottomed through, you got hammered, and we bottomed below the 200-day. Let me show you what this looked like. Change this date to 3/17/2020. So this correction might lead and birth not just new leaders, but a resumption of the leaders. 2020. Okay, so okay, let me go day by day on this. So there's, this was a leading stock. 2020. Okay, there's the leading stock. Then it came all the way down to and took out the 200-day. And so, through the 200-day, look, it got, cut in two. And then this was at the bottom of the COVID bear market. And then what happened? And I'll just go out just to show you. 2020. Let me just go out to December, say December. And there's the bottom. See, there's the bottom. You came in 50%, and then it proceeded to, triple. And so, now look how choppy this was. And, everyone knows the Shopify story with Amazon and so forth. But, you had a 50% correction, got down here right below the 200-day. People gave up on it, but it had the numbers, it had the fundamentals and the earnings to propel the stock higher. Tesla did the same thing. Tesla hit right there exactly. It was down more than 50%, down 65% to the 200-day. And then it proceeded to go from 70 to 500, in the next 6 months, because they had the numbers. So maybe it is something like a Reddit. Maybe it is. And their report was quite good. And there was some communication that Amazon had changed something in their algorithm, and it's back to normal. But this company has really terrific numbers. So what I'm pointing out is some of these stocks that have gotten blasted, if they have the numbers, this might, in fact, be a great provide a great tradable opportunity. Remember that Shopify came up and hit the 10-day, then it came down and it rechecked before it maneuvered higher. So, keep that in mind. Again, things like Robinhood with, they have, very, very good numbers as well. And, I was watching this to see, if this is going to go to the 200-day or not. But, it made a higher low right here. So, again, you have a number of these stocks that can repair themselves over time. I don't think Palantir's over, but, the chart broke heavily, and that's, what a correction in this particular stock. And I don't think they're going to lose any contracts with the government because CARP is tight with Musk, and they've got a great product and so forth. So it is possible that that these prior leaders are going to resume their leadership when the carnage is over and when the dust settles. So don't give up necessarily on these names, but the biggest and best coming out of the gate are going to be the ones that are making new highs first in price. I thought Nutanix was going to be on that list. It broke into new highs recently, on their earnings report, and it just got caught up in the last 3 or 4 days. But this is the type of screening that you should look at. You want to screen for those stocks that are within 5% of a 52-week high, and just constantly run that screen and update it every day. But a style like this could certainly come all the way back and then make new highs. Oh, by the way, the Chinese stocks are leading the market now, so you can pick whoever you want: BABA, FXI, Futu, QFIN, QFIN. But the safe way of playing the MCHI, safe way of playing China is is really the index is FXI and MCHI. But BABA would be the individual stock that's looking like a leader. And of course, this is that XPAV. See, look at what's going on behind the scenes, despite all the rhetoric that's going on with China. But look at how this looks from a long-term perspective. So this is just getting going after not doing anything for years. And again, from the IPO, this stock is just pretty much at the IPO price, and that's been 10 years ago. So you see something unusual that's going on here, despite the idea that we're casting disparaging remarks. And so again, if you're watching the headlines, the headlines will keep you out of the position, but the stock action is going to tell you to get in the position because something's changing. Maybe the market is discounting that a deal is going to be done with China, that we're going to negotiate with them and we're going to be big buddies in the future. Maybe we pull, we have an understanding with the tariffs with those guys, and then they're off to the races. Maybe they're going to stimulate their economy by lowering their interest rates and funneling money into these individual companies. But whatever the case, it's been in a huge downtrend for years, and now you're in a stage 2 uptrend now. So that's what we're looking at right now based on the action in the individual stocks. It's Chinese stocks and select biotech stocks that we're trying to get our hands around. BGTX.
Any thought on Take-Two Interactive, Roy?
Yeah, it was a leader. it was on our screens as well. And so there you're in a great stage 2 uptrend. It's at the 10-week daily. It looks promising. 90 relative strength. It's consolidated nicely. And look at apparently, I don't know where these projections are coming from. Maybe it's expected, a new game or two that they're working on that are going to come out. Who knows? But you've got great visibility in the future, and the stocks chart is certainly showing you that, corroborated by volume and the breakout. So this is definitely one that you want to keep an eye on as well.
Roy, can you please check Crowd, Spotify, and Netflix?
Yeah, okay. Yeah. Crowd, Spotify, Netflix. Okay. So this was obviously one of the leading stocks, in the market. And now it's, you've got this rolling top. This is what's so difficult, in terms of, what stocks do you buy and when do you buy them? Because you're in a stage 3, like rolling top, and then you've got the consummate break of the moving averages on volume. And so, the numbers are excellent. So, great relative strength. It's been in a leading stock, and this might provide you this would be probably a great trading opportunity back up, into up to the resistance as well. This is one that certainly it's not beaten up the way, say, a Robinhood is. So this would definitely be a candidate for a very short-term trade. And how really, and we'll find out tomorrow how you have to play it if you're going to play it. Is these stocks that are going to take out today that were green up today that were green, and in price, and that take out today's high, and you would want to use today's low as your stop. So you'd buy this stock, all these stocks. You could buy these stocks taking out the high, and with that stop, the resultant stop there. And I mean, if we do have a bottom in the market, then stocks like this can recover. But based on sort of what Wes and I have concluded and what we covered tonight, is we're very skeptical that we're off to the races. We think it's going to be very, very choppy. There's a trade here, and the question is, well, how much do you want to allocate for? If you want to try to play these bounces, do you want to try it with 10%, 20%, 50%, 100%? And that's certainly up to each individual. And we probably would play it, and we'll be talking, tomorrow. And if we decide to play it, we'll probably play it with maybe 10 to 20% exposure, and try to make 10 to 15%, and move our equity curve up 2%, and just chip away. So CrowdStrike, this looks certainly a lot worse than Spotify, and you can see there's the numbers are not great. Numbers aren't great, but again, you can get a bounce to right there or right there on the bounce. But this is what is what you don't want to see, is the stock move down on the earnings report. So it broke on the earnings report. So with that in mind, I would definitely pass on this one. Not to say that any of these things can bounce, but stocks that went down on the earnings report are ones to avoid, while stocks that had a very positive reaction to the earnings report or stocks that you want to profile. And
so, in your opinion, it jumped 7% today when there was any positive sign. So this is like a temporary bounce in your opinion, and it is still, it will be broken for a long time. Okay.
That's our opinion. What was the other stock
A Netflix.
Okay. And Netflix was holding up great as well. And, excellent, great numbers. And we owned all these stocks, by the way, in our portfolio. And, we sold them, so we sold Netflix right there, on that day. And then the break here, the numbers are great. It was made new highs. And so this is one as well that looks looks like it can rebound, but you're going to have all this resistance up here, at the 50-day and so forth. But there, your trade takes you from right there to like right there. So that's about a 10% trade. So, how much do you want to, put in a trade where your upside's probably only 10%?
Mm-hmm.
But 10% is 10%. You could have your whole account in this one stock and make 10%. That's moving the needle. But just keep that in mind.
And Roy, what was the reason you sold at that level? It did not break 21-day EMA by then. So
Yeah, we did market conditions. I mean,
okay.
the FFTY, we had one of the worst breaks in that FFTY in history, and we were just forced out. We didn't know. We nailed it, but we got hit on all this stuff too. But this was telling you that we're breaking out and ready to go and off to the races again. And then you had the false breakout came in, and we sold pretty much there and there because it was just, the damage was so profuse that like, man, these things were coming unglued. What if we didn't sell them? You would have had a Reddit on your hands. So we saw this was going on across the board in growth. So we just ended up taking everything off the table. We had 85 sold 85%, kept 15%, sold it like right there or right there on the last 15% could have been right there on the first 10 minutes of trading right there. And we didn't, but this was something very, very uncharacteristic. And it just happened from new highs to, 4 or 5 days. So, no one can time the market perfectly all the time, but certainly you can exit when you see the damage being done. And this was just very, very uncharacteristic. Again, this was one of the worst 6 days in the history of this benchmark. And so it led to further decline. And so, we saved a lot of money actually by getting out when we got out. But it was purely trying to protect the downside and by having an exit strategy.
So judgment call, like you're seeing a lot more drawdown coming. And yeah, okay. And Roy, just one last question. So stocks which really rose up high today, like Reddit or any of those, can they be the strong candidate when everything settles? Or this doesn't mean anything? Like if something rallying really high today, that really doesn't mean much for like a strong candidates.
Again, the ones that got this was in our buy list, and we own many of these stocks. And let me see. So let me just point this out. And you can take a snapshot of this. This was on our buy list before. And, the ones that move the most, those are the ones that you want to pay attention to. Like Delta Airlines came out with bad numbers today, and that affected the whole travel industry. So you wouldn't necessarily want to buy Expedia coming off bad news like that from Delta. But there's all these stocks. Many of these stocks could be played Monday, Cloudflare, Atlassian, HubSpot, the IGV, that looks like it's setting up to bounce. But there's Dutch Brothers that's gotten hammered. See, so all these stocks are potential candidates for bounces. See, they've been devastated here, 86 to 60, under 60.
Uh-huh.
And I mean, this is a company that had really good numbers. And yet, they threw in the towel because of the market. So, any of these that are on this list are candidates. And let me go down, and you can take a screenshot now of the second half down here.
How about SC, Roy? That had great earnings, but they
Yeah.
really didn't really react because of the market condition.
So we actually we sold this, and we where did we sell this? We sold this.
We sold this ahead of earnings on the same day, probably as Netflix, by the way, where it was the Thursday after Nvidia earnings. I'm pretty sure.
Right there, Wes.
That day. I think that's when we took the everything off right there.
Yeah.
The rest of it, at
Okay.
least. Yeah.
Okay. Yeah. Okay. So broke out to new highs. Now they had a great earnings report, and this is definitely got the criteria that you're looking for potential new leading stocks right here. So SC, and also I think Melly had a really good report, but we were long this, and then we sold it because of the market, and then it broke out to new highs on the report. So you had really good reaction. So this stock is in prime condition to move from here. Great report. And again, we see a lot of money moving into the international companies and international stocks right now. So this is in prime condition. It looks fantastic.
Roy, what do you think about NEO, the Chinese stock?
About who's the company?
NEO, NIO, a Chinese company.
Pass. $5 stock. $5 stock. The numbers. They're losing money. Losing money. It can move up, but it's relative strength 77. XPEV, you saw that looks better. And then what's LI? LI again. This looks better. So I would definitely own XPEV or LI rather than NIO. You want to go with the ones that have the strongest relative strength. And again, this is by no means buyable here. This stock's run straight up. There's no pivot. It's extended. And, there's no really buy point on Alibaba here. I mean, I guess you could buy it taking out that 145 level right there. And, it may embark on, a new move up, but it's certainly a risky buy. But, it is a leading stock, in the Chinese market. And I would expect this stock to go higher based on this market action.
Can I ask you one question regarding the canceling methodology focus on is the earning, but in the IBD platform, they really talk about EPS. They mostly talk about RS. Any particular reason why?
I think, since O'Neill's book came out in 1988, the market's changed. So when O'Neill, published the book, and as I spoke to him, and asked him not about that, but I remember asking him about when stocks when they're leaders and they break 70 on a relative strength basis, then they typically roll over. And so that was sort of enlightening to me. And the other point that I want to make in terms of answering your question is the market's changed, in the last 35 years since the book's been out. For example, we have many, many companies like Amazon and Google and Netflix that didn't make money for many, many years, and because they didn't have earnings, but they were leaders. They were making these massive franchises, these companies that were ubiquitous and that had a worldwide footprint, but they didn't have earnings because they were putting all their money in expanding. But when they finally got earnings, then they had, they were well into their moves. Just like, for example, Spotify. Look at Spotify. And so O'Neill would have never bought this stock because of negative earnings. But look at the move up from, 100 to 500. So, the stock's up 400%, while they continued to lose money until last year. So that was just the market's changed. We have many of these emerging growth companies, more innovative companies that aren't initially profitable, and it takes. So that wasn't really on. We didn't have leaders like that at that particular time. The great winning stocks all had earnings back in the day based on O'Neill's publishing results. So the market's changed.
Can I ask you one more question regarding on the same topic? If you look at the two semiconductor stock, AMD versus TXN, AMD has earnings growth for the last 6 quarters, but the stock is keep going down. And the TXN has no earnings, and it's a bad sector in the auto sector, but the stock went up.
Yeah. And so that's why relative strength is the most important. And look at this stock. When this stock made this reversal, key reversal day right up there at the top, that's when the semiconductor stocks, and that's when NVIDIA peaked right there. They all had that key reversals. And so it was just a hot stock that didn't have great, it didn't have great metrics back then, 3 quarters ago, not great numbers. But AMD was viewed as the number 2 company in the area, but they were a miserable, number 2. They could not compete at all with NVIDIA, and that's the stock action has demonstrated that. Again, the winner, the winner in the sector, it's really this, Broadcom. So, they reported, earnings. The stock went up on earnings. It's down to the 200-day. The numbers are really, good. And they're coming out with, many customizable chips. And, you had a great earnings report there. You had a good earnings report here. And so this is one, I would say, this is probably, the leading semiconductor stock right now. And there's NVIDIA. This is quite concerning when you take a look at the move that, this stock has made, and you can see where it's just breaking the 10-month. And really, this is where true support is. This is how tops, stocks don't continue to go up, go up, go up. So, this is a very dangerous stock currently. So it's right on the cusp. This is a stage 3 topping pattern. So, if I had to bet, I would bet that this stock comes in to this area here. And what is that area? That is, let me see what.
70.
70?
Something like that.
Okay. So, I would think that the stock comes in there, but this is, this is from stage analysis. So you can see where you've got this really, topping formation. And this would be a candidate to short sell on a move back up, right? If you get a move right back up to here. And this is where O'Neill teaches that you should be shorting, not at the top of a leading stock, but when the stock goes sideways, like sort of, it's when they put in head and shoulders formations and you come back and you make the right shoulder, like a move to right there. and that stock probably should be shorted, and it's going to come down to this area on probably on the next leg down, because
Could you please?
the numbers continue to get less and less and less. So I do think they've got peak growth numbers. Now the numbers themselves haven't peaked. You can see on the estimates. But all you need to do is you need to see, some of these hyperscalers come out and say we're slowing down spending, and they haven't said that yet. All the guys like Meta and Amazon and Google have said that they're going to invest so much money in capital expenditures in data centers. But when they back off, then that's when the stocks are going to really potentially get hit. And the market's sort of figuring that out right now in our view.
But if you could look at the TXN weekly chart, and if you see the earnings, it's a sea of red weekly chart.
Yeah, 35 relative strength. Yeah, this looks horrible.
But the stock, even though the earnings were going negative about 6-7 quarters ago, but stock went up.
Yeah. It finally, look at that. So this is, it's hard enough when you have companies that have great numbers, like NVIDIA had great numbers, but again, the numbers are slowing down versus buying a stock that has, negative numbers. So this would not have attracted me. AMD wouldn't have been attractive to me. But the leaders are AVGO and NVIDIA. But again, I think NVIDIA potentially, and this stock potentially is peaking too. We'll just see. We'll see if you come up here to the 10-week and then roll back over. It can get dangerous. It's right there at support, but this doesn't. If you roll over, and we do go into a bear market, then it wouldn't be out of reasoning to think that this stock goes back to 100. So you're right here where it needs to hold. If it doesn't hold and the market rolls, you have obvious downside pressure. Like a move like this. See, this is what I'm talking about. A move like that, where you just, and that was 2022, and that was the bear market, and there was the bear market. You've had this great move up. It would not be out of the ordinary for this stock to come all the way back down to that line.
Roy, I see that you have incorporated the relative strength moving averages in your charts.
Yes.
Do you have any rules to how you use them?
I have them. I'm just watching these moving averages, and this is a new attribute that Market Surge added. And when you're, I pay great attention when you're breaking, the moving average, when you're breaking the moving averages. So that's just giving you, it's really an early warning signal, when you're breaking the moving averages on the relative strength. And so, there's just something that I watch and keep an eye on. I don't have any really hard rules. I don't have any hard rules, with them, but for me, it's just showing me that there's just, some distribution that's taking place and a loss of relative strength, relative momentum.
Great, thank you. And can you look at ARM Holdings, ARM, and what are your thoughts on these potential support areas for going back all these quarters? I mean, they have been going sideways.
Yeah, but this is definitely a stock to avoid. And, this logical support here, you could do all kinds of shenanigans and in terms of where the stocks might bottom. And here, let me pull it up over here on this chart. Let me change 10-week 21. And there's it below the 30-week right now. And again, that's consistent with what I've said before, avoiding the market and avoiding stocks below the 30-week. And let me change this to the 50-day. And go to the daily. I mean, this is, by all measures, see, this stock's below the 10-day, it's below the 10-day, the 21-day, the 50-day, the 200-day. And, where's it going? Now you go over to, that's the daily, look at the weekly, and there's where it broke out of its base. That's where it can go, right there where, it could go to 80. So I'd looked at this, I guess, before. And, this is at this 21, this is at the 21 month. So, this is where it should hold. Or otherwise, it's going to continue to get punished. It's, so you can there's no really great way of predicting, how low will it go and how low can it go. But it's definitely a stock that you would want to avoid. Many of these other candidates are much better, better candidates for the bounce.
In same sector, we have A Lab and Marvel.
Yeah.
Do you have any opinion on those?
Okay. Okay, man, this was, and we were long in this stock. We were long, A Lab and Credo. As well. Look how great this stock was performing, just like VRT, the double top, the move back up, the stage 3 topping formation, the break of the 30-week week. The break of the 30-week that just took place in the last 2 weeks. But look how it dropped. Look how far this stock dropped before, you got this sell signal on the 30-week right there. So, clearly you got to there's your sell signal right there. There's your sell signal when it broke down on, that was the Deep Seek AI play right there when it got clobbered. So,
if it turns back and comes back up about 30-day, will you be interested in it again, or this whole sector is broken now?
I would never be interested in this one again, and back until it comes back above the 50-day on a break like this. So it's going to take, now the bounce might take you, 66 to 76, but that would be a gift if it bounces up to the 200-day. This is going to take, this stock's probably peaked for years. It's going to probably take a couple of years before it can go to new highs, new high territory. So, if you get the bounce, you should be selling into that bounce there. And there's Credo, same situation. There's a deep seek break, and we were actually long this. We sold it right here the day that it broke, and we actually had a 20% profit that we ended up taking a loss on, and we blew out of it. And we did a series on selling recently, and we talked about expectation breakers. When you get an expectation breaker, you sell immediately. This happened to come. You got lucky and it came all the way back almost, and then it rolled over. But, normally when you get breaks like this, in many cases, they gap down and then and go straight to the 200-day. So it's better, the odds are that it's better when you get a material break like that, the odds are to go ahead and sell first and ask questions later.
Roy, in this kind of situation, how do you really identify it is double top and not actually a new base it is forming or stock is resting? Is there any way, I mean, like before it comes down significantly, breaks 50-day, that might be too late sometime. We already lost a lot of money. And so
it's just visualization, and it is really an art. And you look at different things, different momentum signals, but it is really an art, and it's very challenging to always get it right. But in a case like this, you would have looked at the break, and then it came all the way back and made the double top, and like if you were shorting, there's the day that you would have shorted the stock right there. If you're so inclined to short, when the stock made the first lower high and lower low, that day right there was your exit point. And we do very little shorting in individual stocks because of the risk of getting caught in a short squeeze. And so we just pretty much stick to the indexes. If we the inverse indexes, if we're going to short, but there was the day to short the stock right there. It's always easier to look at in retrospect versus managing risk real time.
Yeah, I mean, A lab, in hindsight it looks really perfect top, double top, but when it was there, uh, I mean, now I can see perfectly like
Yeah,
it was.
yeah. And it was, I mean, it's the idea. It had a big move. It was way extended above the 50-day. There were a few clues, but but here, it just looked like a normal little, consolidation and pullback to the 50-day. And again, then you had the deep seek stuff that happened. I'm not sure if we were long a lab. We were long we were long two or three of these. When that came out, let me see if we were long VRT. I'm not sure. We could have been long this VRT as well, and I'm not exactly sure. But if we were long, we sold that day of the break, and you can see this didn't remember the other stocks. A-Lab and Credo came all the way back almost. This came all the way back to the 50-day. So again, we're rooting for we are rooting for a reversion to the mean trade. We're 3 ATRs down. That's suggesting that the market should bounce, fairly significantly right here briefly for a few days because we're so oversold. But if we don't, then there's going to be fireworks and really blood in the streets if we don't bounce, here tomorrow probably. Tomorrow, Thursday, and then we got the weekend, and people are going to be worried about, carrying stocks over the weekend and news headlines. It's just going to get very, very, very choppy, and so you want this. We want a new market environment, guys, just like this. See, look, just transitioning from a choppy area to this nice uptrend. And you get two or three of these in the year typically, and that's all. You get two or three of these moves in the year. We made all of our money last year, and we had a great, we had a phenomenal year. And let me see, there's the weekly. Let me change this to the daily, and make this smaller. So, I mean, last year we made all of our money from, from January to March, 3 months. You had that drawdown. Then you had this move here. for a couple more months. Then you had this big 13% drawdown. It took you, quite some time to make it up. And then you had finally, this last little hurrah right there. So you had three different episodes, episodic times to make money. And that was it. So, you want these brief periods that you can maximize, your gain. And, if you can identify the leading stocks, it only lasts a couple of months, typically. And, the keys to maximize it. The keys, obviously, to avoid as much as you can of these downturns and, and get the transition into the new upturn that lasts a couple of months. Don't think it's don't think it's not unusual to have these pullbacks like this. Normally you get 3 or 4 of these pullbacks that are anywhere from 7 to 15% in the course of a year. And so you got to be able to understand when the trend is going your way and know when to put the pedal to the metal and press the accelerator, and the times to take the gas off the accelerator as well. So we're definitely taking the gas off off the accelerator. But additionally, all your money is going to be made when the indexes are going to new highs in price. And so, throughout the year, you're going to have these, when the market's in a corrective phase, you're going to have a few of these oversold plays that you should be, selling into. But the real move takes place when the averages are going into all-time high territory. So I don't think we're going to be in all-time high territory at any time soon. And, when you go through this corrective phase, it gets, the real money is made when the indexes go to new highs. So we're not, this is where you made most of it. There's 2024 right here. The money, it was very, very difficult to make money for 2 years. And then you made all your money when the indexes went to new highs. See right there. Now it's going to take some time for us, based on what the market looks like, for us to get into new high territory. I mean, I think it's going to take months, but seasonality it's in our favor here. And, but I just can't see us immediately rebounding to all-time highs. Certainly with the damage done and all these leading stocks, they're not going into new high territory anytime soon. So, it's going to be treacherous ground. It's going to be very, very difficult. And, there's going to be these opportunities that we're alluding to where you get the oversold bounces, and that's going to be your opportunity to make money. The question is how aggressive do you want to be to take this trade from right there to, right here, and that move to right there to right there. Again, you don't want to put 10%, 20%, 50, 100, 200%. And so that's all based on your risk profile. Certainly, yes, let me just say one thing. Certainly, I'm very aggressive personally. And so, I could easily, put a big position on in one of those triple leverage ETFs, but I would, we can't risk, client capital at all for something, that might not pan out or not based on the market environment that's behind us. So you have to make that decision for yourself.
Is there a possibility we are in the similar like 2000 to 2002 era?
Yeah, it's possible. Yeah, more like 2000. Well, we'll just see how things transition. But yes, I mean, all bear markets start just like this. When you go back and you look at the 2000 top And let me change the date. That's what the 2000 top looked like, the first break right there. And this is that's the daily. There's the break. And so we had this big move down the way that this FFTY just broke and just got hammered like really quickly. And I recall, this is the 2000, 2000 top. And I had made just a tremendous amount of money. And then during the course of like 3 or 4 or 5 days, all these stocks came in like 25% and in 3 days. So that happened really quickly. But look at how it broke the 200-day, came back up. The red line's the 200-day. You got this bounce, came up. Oh, I'm sorry. I've got the wrong date. That's 2020. Let me go to 8, 19, 20. Date. Oh shoot! I need 2000. I'm trying to get the 2000 top. Excuse me, guys. Sorry.
Maybe write
I
zero.
think one more. I think you have to type
Just
zero,
put two zeros.
zero,
Okay.
zero, yeah, in place of 2000.
What software is this?
It's AIQ, artificial intelligence software. It's I've been using it for 37 years. I like the way that it gives me the visuals. I like the look of it, and it's much more precise than Market Surge and other charting programs that I have. So the 2000, there's the 2000 top, and change it to daily, and see these are the cues, and there you had the break. And, you had this subsequent rebound back to the 50, came all the way, back breaking all the way to the 200-day. But you can see that, you had this stage 3 top rolled over, and, you got obviously major downdraft. That's, let me change 10-week. Let me change this to the daily. And look at this double top. That looked like that A-Lab top. Does it not? Like looking at exactly the same type of chart pattern.
Yeah.
21. Change this to the 50. And there's the double top there in the NASDAQ. And, so that was quite a drop right there, from the top. So you had this period. This was very, very unusual. You had this blistering move up that just lasted, like 3 months. And this is where you made all your money in 1999. And all the internet stocks were peaking. And then finally, the broad averages peaked right there at the top of March of 2000. So, when you get bad market environments, they all start the way that we're starting right now. So you don't know you don't know what this is going to morph into. So you got to be, you've got to be careful. So there's the 2000 top, '07 top. There's, just looking at that, that's how they start, just like that, with the break, the bad break, just out of the blue. NASDAQ. Oh yeah, okay. So, you get these bad breaks, these corrections, they come just, they just come, but, a lot of them look, very, very similar. You get this is what they do when they roll over. You get the subsequent short term, rallies that last a couple of months, then they roll over again, choppiness. So it's rare that you have a market environment like a 2017 where you have very, very little volatility, and that's what you're looking for. But most of the time, you've got to deal with all this choppiness. So it's very, very challenging.
Roy, can you take a look at 2018 after 17? And 2018 also was driven by tariffs and Trump China position.
Yeah, this is just as a note. This is how rarely do you get a situation like this. 2017 was a great year, but that was coming after the 2015 and 16 bear market. And once you got in like November, January, you really got going in 2017. But you didn't even break the 50 days significantly the whole way up. This was a great, great year. And that was 2017. And I mean, that was just one of these rare years where, we held every time you hit the 50-day, it was a buying opportunity. And did you want to pull up a stock or?
No, I just want to see Qs and SPY as a point of reference to what's happening now.
Yep.
So 2018 came, 18 came after 17. It's like last year to me. And then 2018 was very volatile. We went through 200 days moving average a few times.
So there's 17. Now we're going into 2018. Yeah, they got chopped, but that was, 2017 was so solid. And then it got, so obviously when you have these big, years like that, it's followed by, many times choppiness.
Yeah, here you go. So we tested 200-day twice, and then we broke through.
Yeah. So this is, this is what you have to be careful of. That we come down, right now. You come down to the 200-day, and then you have all this to deal with. And this is why this really is a perfect example where you had, from these days, if you look at how much they're up and how much they're down in these bars, it was extremely volatile. But you had a 5-day bounce there. You had a 1, 2, 3, 4, 5, 6-day bounce here, and it's just I expect more of this. I expect really choppy action for the next few months. I don't know if we bottom right here at the 200-day, or if we make another leg lower. My thought is that we're going to make another leg lower before it's over.
I have a hypothetical question. Let's say if you were lucky enough to put a collar on your position, how one should manage it now?
Can I ask the stock?
SPY index.
Okay. Let me change the date. Man, I think I think you're in a prime position. I mean, this is where we could go, and we could, if this market really rolls, we go to the 200 week, and there's the 200 week right here. And if you go back historically and you look using this 200 week, when you go back and you look, this 200 week is very, very important. And you can see where in bear markets you come down to the 200 week. That's how nasty it could get. If we just completely roll over, the economy goes into a recession, all these, it gets worse and worse and worse. That's really where it can go. Really where it can go. So, you're in a prime position, having the collar on. And I think it's going to be very, very difficult to make new highs, without us like consolidating, but the S&P is holding up much better than the Qs and the NASDAQ. So, I mean, you can't get hurt. So that's what's nice about having the collar.
So let's say expiration date is towards the end of the end of the year, 610, 600 collar. So one should keep it.
That's just too hard of a call. I couldn't answer that.
Okay. Thank you.
Hey, Roy, can you take a look the stock, the AGI and BBVA?
AGI?
Yes.
Okay, so Okay, so I don't have it here. That's a gold stock.
Yeah, a Canadian gold company.
And I've got it over here. So gold's been a leading group. So we don't own any gold stocks, but gold's been holding up. It's in an uptrend. All the gold stocks, they do look good, and they look you can go across the board. They're definitely leading. There's AEM, which it looks fantastic, and it's the group's been out. The group's long term. It's just again, it's got this huge base. That's a 17-year base, and we are questioning whether or not we should buy this stock. You can see it just broke out into new high territory only in the last 90 days after getting through this. And we have a friend, and he calls this a Brobdingnagian base, and that's a long-term base breakout. And that looks this is an area that looks great. You can see where the GOD broke out this year, and on a measured view, like that was from roughly 190 to 100 points. So 300. So this translates to a $300 measured move up here. What was the other stock that you're talking about?
BBVA.
BBVA?
Yes.
Okay, a bank. Brazilian bank. So short term, it's in an uptrend. This is the money has been flowing into capital has been flowing out of the U.S. into the foreign countries. Europe. Europe's been hot. The emerging markets. Well, not so much right there. What's the EFA? Yeah, these are poking up a little bit. So, money's coming into these these international and developed markets. So this is, it could be, it's starting to get a little bit of leadership. So maybe money's coming out of our country and it's looking for a place to go. So money is flowing right now into the international markets. I clearly see that.
Can you look at IBM, please?
Yeah. So, great breakout on, big volume. This stock's been really it's been desolate for years and years and years. I'm wondering if something's finally changed here. We have talked about it over the last, 6 months or so. And, you've got the stock broke out on the number. Let's take a longer term look and see what's going on there. Weekly looks great. Monthly. And man, this is talk about a long base here as well. And this is, look, so that's a 12 or 13 year base that it just broke out of. So, it's definitely, the stock's definitely now breaking out. It's definitely interesting. The question that I'm posing to you and posing to myself is that's a 12-year breakout. How about when Microsoft broke out right there after going nowhere for 17 years?
Yeah.
And then you had the breakout. Maybe that's what IBM's doing right now.
Yeah, it's just that it is completely contra to the group it is in.
Yeah.
And in its group, most of the stocks are not doing well. And I was just wondering if you knew some story about it. On a very similar scale, there is VeriSign, VRSN.
Yeah, doing the same thing. Yep, doing the same thing.
Defying gravity. And I was wondering, are we missing something in the story?
Well, apparently I am because I don't own it. But I'm contemplating the same thing that you're mentioning.
Okay, thank you.
Hey, Roy.
Yes.
Fiserv. FI.
I mean, this had the great move. Then consolidation, move up still. This is kind of one of those, this is one of those stocks, if you were lucky enough to buy that breakout, like again, like IBM and Microsoft, maybe an IBM turns into something like that. But let's take a look at the numbers. A very, very nice large cap company, 119 billion. Great growth, much better than these smaller companies. 16, 17%, and but obviously it's getting hurt here in the market. But obviously it's one of these stocks like that's a cash cow like Visa or MasterCard or something like that. So it just made a new high just a few days ago. Excellent relative strength, and it's just been a horse. So you do have some higher distribution, over the last few days. It had a good response to the earnings. This is really a tough one.
It seems like the company which provides technology to the specific industry, those tech companies are doing quite well, like FI, TradeWeb, or Doximetry, and in the restaurant stock, there are a couple of in the restaurant as well. I forgot their name.
Toast, Shift 4.
Yeah, Toast or ARMK, which is more like supplier.
Yeah.
So instead of actual from the technology, you can go to the sectors.
Yeah. Yeah, absolutely. So again, you're going to get your biggest bounce right here in technology. But then there's going to be, more than likely, there's going to be this rotation that takes place as the market moves to find, as it tries to explore and find, the new leadership. But, stocks like this, they can give you the biggest short-term bounce. That was an earnings report, and, it's come all the way back in, to its support. And now, these are the ones that you want to play, the ones that had a really good reaction to the earnings report. They came in, and then you're going to get that trade when they take the pressure off, and you're going to get the consummate bounce and take the bounce and exit.
Roy, what do you think about Amazon? Is it moving into stage 4 now, or?
Yes. And let me take a look at it where you can see in stage 4, that's when stocks have been in a prolonged uptrend. Nobody's asked about AppLovin, but let's take a look at Amazon. And let's take a look.
AppLovin and Exxon.
Yeah. Let me see. I want to go to daily. So, Weinstein talks about, this topping pattern, the topping pattern. And then when you break the 30-week or the 150-day, that's when the stage 4 begins. So, yeah, this looks like it's in the beginning stages of a stage 4. But here, look at the false signal that it gave you way back here. And move this, where it broke, and then it came all the way back and, made, move higher. And so this is, guys, this is the proverbial many $1,000,000 question for me anyway, is like, are these things in the midst of stage 4s? And so you can make this case, this is not a good looking chart. And, and now, everyone is flocked into these stocks and, that are rolling over. This, in my opinion, in Wes's opinion, you don't want to, this is clearly, in the topping pattern, you clearly in a stage 4 decline. And, then you have to, like, where can this thing go? So if you get a bounce up here, to the 30-week, 150-day moving average, that would be, in my view, that should be shorted. And it's going to take time. It's going to take time. There's your, the next move down right there. Let me look at the monthly, and let me remove some of this. And when they break the 10-month, and stocks that are in big, long-term uptrends that break the 10-month, I mean, I'm just seeing so many of these that look like they're topping. Delete that, delete that. So, when you break the 10-month, so there's the 10-month, you can see the momentum turned over. You're in this, the midst of this downturn. Mm-hmm. This looks exactly like the beginning stages of here right now. Does it not?
Yeah.
It looks, whether or not, what happens or not, we don't know. But this looks like this looked over here, and you had this big move down, and you're breaking. You broke the 10-month and the 21-month, and just pick your poison. There's the next support. You got this rolling 50-month. So there's here's where I would expect this stock to go. That's where it looks like it goes eventually. Now it takes months. It may take the rest of the year to get here, but I don't think, in my view, I don't think there's any question that this stock is not going to make new highs. I mean, I think there is a question that it's going to make. I don't think it's going to make a new high anytime soon. I think I think there's a greater chance it comes here to this next level of support. And after being in this big uptrend, the correction, the next leg up, this looks definitely topping to me. So, and they all look this way to me. So you got to be very, very careful in these stocks. Big cap, thinking that it's quality. The stock's only quality if it's going up, correct? So don't ride these stocks. Do not ride these stocks all the way down. And thinking that you're waiting for the bounce to get your money back or get even. If we're lucky enough to get a bounce in this stuff, your perfect shorting opportunity is coming back up to the 50-day, and that 50 days declining. And so, the 200 days rolling over, the 50 days declining, you're in definite downtrends there. So the character of this stock has changed. So you want to be shorting the bounce on the stock. And the bounce, we'll just see, we'll see what happens and how high it goes. But I doubt this stock gets anywhere close to the 50-day. It's going to be a choice. And this is a widely owned stock, massive stock. It's going to take huge firepower just to move it, back, to the 21-day.
Hey, Roy, going back to Toast, if you're on a stock, if you feel like you're on it early in its growth cycle and you have you can see the vision for it and the earnings are starting to come in, but we run into this scenario where the market is just feeling really heavy and coming down. Do you try to trade incrementally from a position trading standpoint to almost an investment time frame?
I've never had a stock that I've never held a stock that I've had a long-term capital gains in. So over my whole career, because I can't stomach the drawdowns. And again, NVIDIA, which was a leading stock there in 2018, had a 65% drawdown. And I couldn't stomach that, but I would love to have, we looked at that Fiserv earlier. I'd love to have one of those. And I love the technology in Toast. I love the technology. This certainly you can make the case here that it's just like going, it's just consolidating. But it's down here, at the 200-day, but it was a leader. The product's really good. It's excellent. They're in thousands of restaurants, and they definitely have the leading technology. So I would love to be in something like this and be able to hold it for a long period of time. Say if I got into it, a year, or when it broke out, if you bought it up here at 25, it's really not up that much actually. 25 to 33. I really like the long-term prospects of this company. There's the IPO, the distribution phase, the phase where all the institutions did their due diligence, then the advanced phase coming out of that due diligence phase. I'm watching the company. I'm definitely watching the company. And, but, if the economy slows down, if we go into a recession, restaurants are going to be hurt, we'll see, how that goes. But I do love the technology. And, I'm not convicted enough. I loved Kava too, but look what's happened to Kava. So, it looked like, Kava, there was a key reversal day. It came in the way Toast is holding above the 200-day. You got the rally back up, and then it rolled over. And so look at that. So I couldn't stomach, that 50% decline just like that took place, where it looked fine until it didn't. And then, the subsequent move through the 200-day and the move down. So there's just so much uncertainty in terms of the recession and the slowdown with the consumer that, if the consumer slows down, the restaurants are going to slow down. And, there's CMG below the 200-day. There's Shake Shack. See, this is sort of, it's you've got to question the consumer and the threat of recession when you see this kind of stuff here, because that's what the consumer does. They go out to eat. So what's going on here? And it's just really shown itself, in the last, 60 days or so. Wingstop, WING. I mean, there's the break. See, there's the break. You always sell when you get the break like this if you own something like this. So, I love Toast, but you can't ignore negative action either. If you get a move like that, it would be, all she wrote probably. Guys, I'm gonna go about another 10 minutes, and we're going to call it an evening. So, if there's anything, any stocks that you're really interested in, ask me about. Now's the final hurrah.
Sometime back, Roy, there were a lot of noise about TEM, and HIMS. I think, HIMS. What is your opinion about these? Are these like pump and dump kind of thing, or they have real?
And we tried this a couple of times, and Tim is probably the premier AI drug discovery firm in the world today. But they don't have any earnings. They don't have any earnings, but you had this big move on the big AI hype, and the quantum stocks were very similar to that. RGTI and that group, QMCO and all the quantum stocks. But it got caught up in the hype about the AI hype. Of course, they don't have the numbers, and then they sold off because they don't have the numbers. But you've got a great. They've got a great board. Scott Godfrey is on the board. He's on the Illumina board as well. He was the FDA chairman, and so it's they're not quite ready for prime time, but their board is very distinguished. And look, they are expected to make money next year. So this is where, this clearly, in my view, an IPO, and I love, IPOs that finally get into new high territory. So I imagine the next time it gets into new high territory, then game on. And it wasn't ready for prime time. There's your green line breakout right there. And then it failed right there. So this is, it's one of these companies that has, speculation all around it. They're actually, they're doing great revenues, but they don't have any earnings yet, annually. But, I would definitely keep this on my watch list. It's just not quite ready for prime time, but it could be, if once they launch their first drug. But, this is the leader in the drug discovery area. And who was the other one?
HIMS.
Yeah.
HIMS.
And this is definitely broken. And, this was a hot stock because of their GLP-1 drugs. There it broke out. You had this big, massive move. And then you have the competition. And the competition, it's certainly NVO and Lilly. And Lilly and NVO, they're defending their franchise, and that's why the stocks dropped like that. They're kind of getting they were going to sell Ozempic and Mounjaro for like $200 a month, and I'm actually taking Mounjaro for diabetes right now, and I've lost a lot of weight as well. But I pay $1,200 a month for mine. And so they, Lilly, obviously they're going to protect their franchise. So this is definitely a broken stock. But there's Lilly, and NVO is clearly second fiddle. So, this is telling you that Mounjaro is much better than Ozempic as well. But everyone knows Ozempic because they were the first that came to market. But Moderna has got much higher efficacy according
Hey,
to
Roy,
stuff that I've read. Yeah.
there's also Viking Therapeutics,
Oh
which is
yeah.
the same pool, but they apparently have the best results so far of all the testing. And today they signed a deal to start manufacturing with a company.
So companies, this has got horrible relative strength, 6. So it's been outperformed by 94% of all stocks in the exchange. So it's definitely a no go. But these stocks, the new leadership, like when you have something like that occurs, that's a big fundamental catalyst. So we're going to see some of these stocks. Look at it way over here. This stock went from 20 to 100. So right now, the market's not recognizing any because the market is very scared. But if this turns into something, that could be good news. But it didn't have a good reaction. They sold it down on whatever the news was, but that's 81 all the way down to 26, down 75%. So you could always have room for a stock that were with a promising new drug or delivery system or something like that, but you shouldn't put very much money into something like this unless you really knew that the company was onto something that the market wasn't aware of. But the problem is, Wall Street is filled with many, many analysts that follow all these innovative drugs and drug discovery delivery systems and things like that. So it's going to be rare that they don't know about it. But it didn't have a great reaction to the number.
Ironically, today the lowest price target on it is 102. It just blows me
Wow,
away. 102 lowest price target.
that's crazy. I mean, the price target when whatever the news was back here in the earnings, that's when the price target, that's when they raised their price target on it. I'm sure of that. Because I know how these guys work. But what's going to happen now is they're going to drop the price targets from that 102 or 130 or wherever it is to like 40. And because the stock's broken and they're Wall Street's just like anybody else, at some point they've got to throw in the towel. And I understand that Dan Ives was out today making, and he had a $560 price target only a month ago, and now he's backing off. Apparently, that's what I heard. I need to watch the YouTube video on his comments, but he's sort of backing off on Elon now. And he had a $560 price target. I guarantee you, these price targets are going to come down. Even he might, lower the price target from 560 to 350. But and he couldn't take it anymore, and he sort of threw in the towel on it. That's what I heard. But this stop right here, you can get the rally right here to the 200-day, and what is that? That is 21%. See the move right there to there, but that's where you sell it. You get the move to right there, 200-day, and sell it because their deliveries are down 75% in Europe. I saw Denmark, Europe, China. China's kicking their behinds with their vehicles, and so. But you have this tradable bounce. Right here, tradable bounce that lasts a few days, 4 to 5 days, and exit. But a good way of play. But if you want to play that. You could play that in ARK, ARKK, that owns, Robinhood. They own all these stocks that have been beaten up, and your trade on ARK, there's 48, and so your trade goes right there. best case, and like right in here. So that's 53. That's 10, and the 21 is 13%, 14%. So again, we're seeing that all these stocks on a very temporary short-term bounce. You've got an opportunity to make 10 or 15%, 20% in some things. But let me again reiterate, sell the bounce, get the bounce, take the bounce if you want to participate, but sell the bounce. Okay, I'm gonna call it a night, guys. Thank you so much for attending. I hope I wish you guys well in your trading results. Thank you again for attending, and trade well, and just keep those stops out there, and be aware of the volatility that we're going to experience.
Great meetup, Roy. Thank you so much.
Thank you, Roy.
Thank you so much, Roy.
Thank you, Roy.
Thanks, Roy.
Thank you, guys.
Thank you, sir.
You're welcome. Have a good night, guys.
Good night, Roy.
You too.